I'm Strongman, the sailor man. I live in the trees with two cans. I turned on the heater and blew off my finger. I'm Strongman, the sailor man. Choo choo. Welcome back to Strongman Personal Finance. In this video, we're going to cover a fascinating new ETF that I was paid to use my expert accounting knowledge to evaluate. And let me tell you what, from the perspective of a boglehead investor, I'm going to tear this ETF apart. But if you're interested in a global shipping ETF, boats, then this may be the ETF for you. I would say you should buy VT, but whatever. Now, before I dive into it, if you want a paid personalized video, click that link, you send me $50, you email me, and I'll make a video for you. Let's dive right into the topic of today, the boat ETF, the Sonic Shares Global Shipping ETF. What is this? What's going on here? This seems like a very, very specific ETF. What do I always tell you, people? You want broad diversification. You want to own everything. You want to own tech companies. You want to own manufacturers. You want to own car companies. You want to own everything, okay? When you buy something like this, imagine this is part of your whole portfolio, okay? Imagine you have a portfolio and you have like VT and VTI because you're a clown maybe, and then you decide to add the boat ETF. Let's say you make this 10% of your portfolio. 10% of your portfolio is now concentrated in the shipping industry. 10% of your future wealth is on the line with the shipping industry. You have overweighted shipping and you have underweighted technology, Apple, Microsoft, Amazon, Tesla, blah, 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 for whatever reason, okay? But this is a relatively new ETF. So let's get into it. It's a relatively new ETF. It went up 12% in the last couple of years, which I guess is not horrible, okay? And I remember the whole shipping industry, there was a lot of demand for, shipping, and shipping rates have gone through the roof. That's a big reason why I think a lot of people are into these shipping companies. The rates, and I've looked at other like shipping stocks, the rates that they were able to charge for chartering their vessels were insane. Like there was so much demand when the pandemic started to abate that rates went through the roof. And that meant a lot of profits. But this industry just seems very cyclical to me. It's very heavily dependent on the global economy. Now, let's look a little bit more about what this ETF is. The Sonic Shares trademark, yeah, you could have that name, provides pure play exposure to the global maritime shipping industry. What other shipping industry would there be? I guess air. The air shipping industry. Boat, B-O-A-T, is an indexed ETF that seeks to provide performance results that correspond before fees and expenses to the Solactive Global Shipping Index, okay? Now, I looked up this index, and basically, here's the history of the maximum history of the index. Apparently, it's been around since December 18th, 2015. And for the 4 years before the clown market began, it was basically flat, okay? There was basically no gains. I'm pretty positive the S&P 500, and I'm pretty positive VT as well, outperformed this ETF. But why did it go up so much? Because shipping chartering rates went up massively. Okay, supply and demand, the rates went up massively. There was a huge demand for shipped goods when the lockdown started to abate. So you could see the ETF just went absolutely to the moon. I mean, massive. Look at this. It was, or the index was like in the 56. And now, or at least it went up to almost 200. So that's almost a 4X or a 3X right there. That's a huge gain. Okay, it's a massive freaking gain. So people are probably looking at this like, wow, it went up a lot. Well, if the trend reverses, this ETF could get absolutely wrecked. Okay, so let's keep reading. The index consists of global shipping companies, at least you're globally diversified, engage in maritime transportation of goods and raw materials. Maritime shipping is considered the lifeline of the U.S. and global economies, as around 90% of the world's trade is carried by sea. No duh. Okay. Boat tracks companies like Zim, Danos, Matson, Starbulk, Ockle, my cockle, and all this Costco. Costco? Costamere, and Navios, and all these other companies. Now, I read a little bit more in the information that was offered by the ETF provider, okay? And here's some interesting stuff they said here. It is not clear how much higher container and dry bulk rates may rise. Remember, the rates went up massively after the pandemic. Fitch Ratings expects container ship rates to remain high in the short term, but believes that they should moderate in the long term once shipping supply chain disruptions are cleared and more new ships are deployed. It's a supply and demand thing. Everybody sees that shipping rates are high. They want to get in on it. That leads to more supply of boats. And what does that do to prices? Brings them down, okay? See how it's cyclical? Oh, everybody wants in, and then rates get bad, and then everybody wants out, and then everybody gets back in. It's a cyclical industry. Look at this, okay? Another source, Drury's container forecaster. Imagine if that was your job, container forecaster. Expects container rates to remain elevated until at least 2023. Oh, you mean this year? Like container rates, dry bulk rates are expected to remain high until at least until 2020. So this was definitely published a couple of years ago. At the very least, we believe container ship lines and bulk dry shippers should benefit financially in the short term from a combination of growing freight problems and continued high shipping rates. However, the cost of compliance with increasingly stringent environmental regulations, such as the International Maritime Organization's limit on vessel sulfur, too much sulfur on your stuff, will place significant pressure on ship companies' bottom lines. There you have it, ladies and gentlemen. The shipping industry operates in a challenging environment, so it's important for investors to do their due diligence. Do you really understand the shipping industry? Really? Are you? Maybe you work in shipping. I don't know, guy who paid me for this. Do you understand it? I mean, I'm not saying I'm an expert in the shipping industry, but I can look at some basic facts about this ETF, and I can tell you that it's pretty concentrated and risky, okay? And what's really suspicious to me is it launched right after there was a massive run-up and maybe even a bubble in shipping stocks. Why? Because they went up a lot. People are attracted to that. They want to invest in those stocks because they went up a lot, and the provider of the ETF can charge fees and make money along the way, okay? So let's dive a little bit more into the ETF. Here's the fact sheet. So here's the top holdings. So it's not super concentrated in any one holding. You have all these companies that I've never heard of before, okay? I mean, I've seen some of these companies like Costco and Mitsui. I mean, I've seen like these on containers and stuff. But, overall, it's not like super concentrated. It's not like QQQ where there's like clownishly high percentages in one company. So let's look at more details of the expenses. So the net assets is only 21 million. That's a very small ETF. 56 holdings, 13.25% SEC yield. Oh my God. I wouldn't trust that. I'm just saying. Okay, I would not expect this. I mean, who knows what it's going to yield. When I see a high yield like this, that actually terrifies me. It's like, oh my God. Most ETFs or stocks that have yields like that are massively depressed or there's some kind of craziness going on. They're usually very risky. Expense ratio, 0.69%. 0.69. That is what? 30-something times higher than the SPY or VOO? 30 times more expensive. That's a pretty high expense ratio for an index. This isn't even like an actively traded index. Like ARK, Kathy Wood only charges 0.75, and she has active management. This ETF is 0.69%. That's expensive, man. Holy crap. Performance, I don't care about past performance. Did it beat the S&P? Let's see. Oh, look at that, ladies and gentlemen. Since inception, it's crushed the S&P 500. I can see why people want to get into it. Yeah. Well, if you're buying it now, you're probably getting in too late, okay? People get attracted to these gains. Like, look at this. Look at this. 41% since inception versus the S&P negative 3%. This thing has annihilated the S&P 500. If you had bought it when it first came out. But if you are buying it now, you might find out that you'll underperform. Just saying, okay? Oh, God. Index composition. So it's actually diversified across. So now you're adding in current, like this is not a hedged ETF. So you have to consider currency risks when it comes to these companies. Let's say the US dollar gets super strong, right? And you have to convert your dollar. You have to convert foreign currency into US dollars. Well, foreign currency, if the US dollar is strong, converts into fewer US dollars. So that may have an impact. But overall, you are diversified when it comes to currency. I mean, only 30% of this is in US dollars. And then we have the sectors: container, deep sea, dry bulk, crude oil, no data. So, okay, yeah, it's a shipping ETF. I mean, what else can I say about it? Let's see. Let's read the summary prospectus. So you always want to read a summary prospectus. It basically summarizes everything about the ETF. So this was effective August 1st, 2022. 0.69% expense ratio, insanely high. Portfolio turnover. This is how much how much churn is in the portfolio. Fund pays transaction costs, such as commission, when it buys and sells securities. A higher portfolio turnover rate may indicate higher transaction costs that may result in higher taxes when held in the taxable account. These costs, which are not reflected in the total annual operating expenses, affect the fund's performance. The portfolio's turnover rate was 39%. Not insanely high, right? But I've seen a lot lower with index funds. This is a very expensive index, okay? Then they go into the different types of, the different components or different categories that fall into the index. Let's see the index composition. So here's how the index is composed. It is reconstituted 3 Thursdays prior to the third Friday of June and December. What does that mean? 3 Thursdays prior to the third Friday of June. So let's figure out what that is. Okay. So when is this next going to be reconstituted? So the third Friday of June is the 16th. So it's 3 Thursdays prior. So 1, 2, 3. Okay. So I'm guessing on June 1st, 2023, it's going to get reconstituted. 3 Thursdays prior to the third Friday of June and December. Okay. And adjustments are made on the third Friday of June and of December. At the time of each reconstitution, the index components are weighted thereby. Each of the 8 largest components by market cap will be assigned an index weight of 5%. So it's not really like a true index. An index is like market cap weighted, right? A true index is like you buying the market at whatever values are and weightings are assigned to each company by the market. So if Apple's 3% of the stock market, it should be 3% of the index. And if Apple grows to 5% of the stock market, then theoretically the index, the total market index, should have 5% Apple. Okay, that's kind of like what a true index does. This is not necessarily a true index. Okay, it's an index, but there's also extra crap added onto it. Okay. Like this thing right here. Oh, the 8 largest components by market cap will be assigned an index weight of 5%. The remaining index components are weighted based on their market capitalizations, subject to a maximum index weight of 4%. So the top 40%, at least 40% of the index is going to be in 8 companies. And then the remaining index will be composed of other shipping companies by market cap weights with a maximum weight of 4%. So the remaining 60%. Okay, the index component will be removed from an index if on selection day, it's like special forces selection day, it does not have a market capitalization of at least $125 million. Okay, that's a very interesting. I don't know, how do people make these things? How do you just sit down and come up with this? Okay, so some of the main countries that are included are Australia, Brazil, Canada, Hong Kong, Israel. You mad about that, Mike? Japan, Mexico, New Zealand, Norway, Republic of South Korea, Singapore, Switzerland, United Kingdom, United States, or any member of the European Union. To qualify for initial inclusion, companies must have a minimum market cap of $250 million. I can at least get behind that. If you're going to get a concentrated ETF, I mean, why have a market cap of $1 million? It's probably a clown stock. And a minimum 3-month average daily traded volume of $1 million. Okay, so that's basically how the index is constituted. So, I mean, overall, you're paying an insanely high expense ratio. You're highly concentrated in one industry that's already had a massive run-up, that's already outperformed the S&P massively. Now, maybe it will continue to outperform. I don't know, okay? But when I see something outperform and I see people want to buy it, usually it's like you're buying it probably because it went up a lot. Okay, that's not a reason to be buying it. So overall, I'm not a fan of this ETF. It's too expensive. It's a weird index. Oh, well, the top eight companies will be 5% of the index, and the remaining companies will be up to 4% of the index. Blah, blah, blah. It's like, what are you doing? Then we have this weird yield rate. What is this? This is insane. Okay. So, no, I'm not a huge fan of this ETF. All right, let's do some comments. Let's see. You're an idiot. Scott Schaefer is smarter than you. That's true. He has more subs. He does have more subs. You're right. You're absolutely right, Cole. Hey, Chris, my ETF are generally up and less stress. I mean, I'm not stressed. Look up Dry Ships. It went bankrupt and was tattooed chef of early 2000s. I will for $50. Ships my nips. That does rhyme. Good job there, fake alias. This is an example of a crappy ETF, my opinion. I don't like these concentrated ETFs. It's like, why? You're trend chasing. I've owned this ETF for 2 years as 0.1% of my portfolio. I mean, you would have made some big money if you had had it as 100% of your portfolio, but that's looking back in the past. Who knows what the future holds, but we'll see. Boatly, my goatly. Should I donate to Lefebvre's GoFundMe for the money he lost on? Yes, give him all your money. I will pass on this opportunity. Would you like to review the EWZ Brazilian Market ETF? 12% dividends. I mean, I could. I mean, if you pay me, I'll do it, but I'm probably not going to like it. Just saying. Boats are disruptive. Dividends for the IRA plus volatile trading can trade the components also. Or you can just buy a total market index in a tax advantage account and leave it alone. Top stock has more dilution and losses I've ever seen. Top stock. What is that? All right, guys. If you want a personalized video made for you, you click that link, you send me $50, and I will make you a personalized video. Since nobody else wants to leave a comment, I guess that's it for this one. Cheers!